Welcome to this PwC webcast on the new standard, IFRS 16 Leases. The standard was issued on 13th of January 2016 and introduces changes in the accounting for leases, which will have a significant impact on the balance sheets, income statements, and cash flow statements of many entities. Meeting the requirements of the standard will also mean introducing new systems and processes, and implementing this could take some considerable time. My name is Carmichael from PwC's Global Accounting Consulting Services team. Today, I'm joined by Patrina Buchanan, Associate Director with the IASB and Project Leader for the new standard. I'm also joined by Tahtah, Accounting Advisory and Leasing Partner at PwC. In today's webcast, Patrina and I will provide an overview of the key elements of the new standard, with a particular focus on the definition of a lease and the accounting by lessees. Jay will share with us the results of our recent global lease capitalization study. This global study analyses the effects of IFRS 16 on the financial statements of some 3,200 listed IFRS reporters globally, and will also talk about the broader implications of IFRS 16 for companies and how and when to prepare for the change. We will also have some time for a brief question and answer session. For those of you listening live, the webcast platform allows you to submit questions, and we encourage you to do this during the webcast. Questions can be entered in the Ask a Question area on the left side of your screen and then sent to us using the Submit button. Our panel will answer a selection of questions submitted toward the end of the webcast. We will begin with a quick overview of the main elements of the new standard. Lessees will now be required to recognise both a right-of-use asset and a lease liability on their balance sheets for almost all lease contracts. This represents a significant change for arrangements which would have been classified as an operating lease under the old lease standard. There are two exemptions available to the requirements. For short-term leases, which are those with a lease term of 12 months or less, and leases where the underlying asset is of a low value, which would be considered to be assets of a value of $5,000 or less when new, companies may elect not to recognise assets and liabilities. Instead, they can elect to recognise payments associated with the leases as an expense on a straight-line basis over the lease term. Although the new standard has a major impact on lessee accounting, lessor accounting remains substantially the same as under the old standard. It is also worth noting that although both the IASB and PwC are issuing new standards for leases, these are not converged standards. There are some common approaches relating to the definition of a lease, but we expect a number of significant differences between the new IFRS and US GAAP standards. However, we will not examine the US standard in this webcast. In addition to changes in lessee accounting, the new standard introduces new disclosure requirements for both lessees and lessors, with particular requirements relating to the nature of leasing activities and associated risks. Although the standard was published in January 2016, it has an effective date for periods beginning on or after 1st January 2019. However, early applications permitted for entities who also apply IFRS 15 revenue from contracts with customers. Those are the highlights of the standard. For a deeper look at the definition of a lease, I'll now hand over to Patrina.
Thank you, Derek. The definition of a lease in the new standard is similar to the old standards and also to IFRS 4. The key elements are that there is a contract, which is an agreement between parties that create enforceable rights and obligations. This contract must provide the right to use an asset, and we will examine that right to use and what that means in a moment. The contract should be for a period of time, and this will generally be the term of the contract. However, it might also be described in the contract by the amount of use of an asset to, for example, as a number of production units. And the final element is that there is consideration involved. So next we'll have a look at what the right to use an asset means. So the first step in assessing whether there is a right of use is determining whether there is an identified asset. Now, assets can be identified both explicitly in the contract, so for example by a specific serial number, or implicitly. So for example, if there is only one asset available, that's capable of being used to meet the terms of the contract, such as might be the case in the case of a power plant connected to a factory. Now, an important factor to consider here is whether the supplier has a substantive right to substitute the asset. And it would have that if the supplier has both the ability to provide an alternative asset throughout the period of use and would benefit economically from substitution. And this would be where the benefits associated with substituting are expected to exceed the cost. So a substantive right to substitute indicates that there's not an identified asset. So if after performing this assessment there is no identified asset, then the contract does not contain a lease. If, however, there is an identified asset, then a customer should consider whether it controls the use of that identified asset. And to control the use, a customer needs to have both the right to the economic benefits from use and also be able to make decisions about that use. So firstly, let's look at assessing whether the customer has the right to substantially all of the economic benefits from use of the asset throughout the period of use. So this could be evidenced by having exclusive use of the asset for a period of time and the rights to the output generated in the form of primary products and also byproducts. Access to the cash inflows the asset generates from use would also be evident, as would rights to any other economic benefits of use. And an example of sort of other economic benefits might be renewable energy credits that are sometimes paid by governments that might be based on, for example, the usage of a solar farm. Now, it's important to note that the economic benefits must arise from use of the asset. Any benefits that arise from ownership, which might include some tax credits, are not considered to be part of the economic benefits for the purpose of assessing whether there's a lease. So if the customer does not have the right to substantially all of the economic benefits from use, then the contract does not contain a lease. However, if they do have this right, then there's one last piece of assessment to perform, which is who directs the use of the asset. So this assessment really looks at the decision-making rights of the parties involved in directing how an asset is used. Protective rights of a supplier, so for example, if the owner of a ship prohibits any customer from sailing that ship in dangerous waters, or if there are particular terms and conditions to ensure compliance with safety regulations, then those would just be protective rights and would not prevent the customer from having the right to direct how assets are used. And instead here, the focus should be on rights to decide, for example, whether and when an asset is used, how long it is used for, or how much output it is used to produce. Now, assessing who directs how assets are used would involve, as I say, looking at the decision-making rights of the different parties to the contract. So where the customer is considered to direct how and for what purpose an asset is used, the contract contains a lease. Where the supplier is considered to direct the use, then the contract would not contain a lease. Now, we expect in most cases that either the customer or the supplier will direct the use of the asset. But in relatively few cases, when the use of the asset is predetermined, such as perhaps in the case of a solar plant or a wind farm, it will be important to look at who operates the asset or who designed the asset for its intended purpose. So where the customer has designed or operated the asset, when the main decisions are predetermined, then the contract will still contain a lease. If not, the contract will not contain a lease. So this assessment of who directs the use is expected to be relatively straightforward in most cases. But for example, when both the customer and the supplier might make decisions about the use of the asset, it might require some judgment. So those are really the overriding principles behind the assessment as to whether there's a lease. But maybe just to illustrate how this assessment works in practice, let's first of all have a look at a short fact pattern for a retail unit. Now, in this example, the contract gives the customer exclusive use of a particular specified retail unit. The contract also allows the supplier to move the customer to an alternative unit, although the supplier would benefit from moving the tenant only in circumstances that are not likely to arise during the contractual term. The customer makes all decisions about the use of the unit, and in this example, the payments made by the tenant have both a fixed element and also a variable element based on sales. So when we consider whether the contract contains a lease, first of all, the fact that there is a specified unit means that there is an identified asset. Although the supplier has rights to move the customer, it would only benefit from doing so in circumstances that are not likely to arise. And because those circumstances are not considered likely to arise, the supplier does not have a substantive substitution right. So in this case, there is an identified asset. Now, as the customer has exclusive use of the unit, the customer has rights to all of the economic benefits from use. And although some of the payments to the landlord or the supplier include a percentage of sales, we'd still consider that the customer will initially receive those cash inflows from sales and thus has rights to all of the economic benefits from use. And the variable payments being made to the supplier are instead considered to be part of the consideration that's paid for the lease. And also, finally, as the customer makes all decisions about how the unit is used, such as the mix of products sold and their selling prices, it's considered to have the right to direct the use of the unit. So therefore, in this example, the contract contains a lease. So next, let's look at a different example. And this time, there's a shirt factory. The customer will purchase a particular type and quantity of shirts for a 3-year period. Now, the supplier only has one factory from which to produce the shirts, but the capacity of this factory means it can also produce shirts for other customers. In this case, the supplier also makes all decisions about how to operate the factory in order to produce the shirts. So again, if we consider whether the contract contains a lease, in this case, although the factory is not explicitly specified in the contract, there is only one factory available to the supplier to fulfill the contract, and therefore the factory is considered to be an identified asset. However, as the capacity of the factory exceeds the customer's order, and there are other customers, then the customer does not have rights to substantially all of the economic benefits from use of that factory. In addition, as the supplier makes all of the decisions about the use and operation of the factory, and the customer in this case has no rights to do so or to change that, the customer does not have the right to direct the use. So therefore, in this example, the contract does not contain a lease. So that's really an overview of the principles behind the definition of a lease and how they might be applied in practice. Derek will now sort of walk through the accounting that is then applied by lessees to contracts that contain a lease.
Thanks, Patrina. As I previously mentioned, the new standard does represent a change from the accounting in the old standard. Under IAS 17, lessees would classify their leases as either finance or operating leases based on the underlying risks and rewards. For finance leases, the accounting would then be the recognition of the physical asset and the lease liability on the balance sheet of the lessee. While for an operating lease, the lessee would typically not recognise anything on their balance sheet other than an overdue lease payment. Then, for the income statement, the lessee of a finance lease would have depreciation expense for the asset and interest expense on the lease liability, while the lessee of an operating lease would only have the lease expense charge. However, under the new standard, there is only one approach. all lessees will have a right-of-use asset and lease liability in the balance sheet now. They will all also have a depreciation expense in the income statement for that right-of-use asset and an interest expense for the lease liability. This change could obviously have a significant impact on the balance sheets of entities which previously recognised operating leases, with a grossing up of assets and liabilities. The impact on the income statement might also be significant, as illustrated in this graph. Previously, for an operating lease, there would have been a constant charge to the income statement over the lease term, as illustrated by the red line. Under the new standard, however, for each individual lease, there is a front-loading of the expense, as illustrated by the dark blue line. Although the depreciation charge on the right-of-use asset might be expected to be constant, the interest expense will be higher in the initial years of the lease term, as the lease liability will be higher at inception. If a lessee holds a portfolio of leases starting and ending in different periods, then this front-loading effect is neutralised, at least to some extent. The lease liability would be measured at commencement based on the lease payments, discounted to present value based on the rate implicit in the lease, or the entity's incremental borrowing rate if the implicit rate cannot be determined. We will look at the lease payments on the next slide. The right-of-use asset initially recognised consists of the initial measurement of the lease liability, plus lease payments which have already been made before commencement of the lease. Also included are restoration costs, those costs associated with returning the asset to its required condition. A provision for these costs would also be recognised separately from the lease liability. And the final element of the right-of-use asset would be any initial direct costs incurred by the lessee in entering the lease. These would be incremental costs, such as payments to agents, which would not have been incurred had the customer not entered the lease agreement. Taking a closer look then at what lease payments would be included in the liability. First, there would be fixed payments. These would include in-substance fixed payments, payments which might be described as variable in the contract, but would in practice always be incurred as there is no genuine variability, such as payments required if an asset is capable of working properly. Next would be variable payments, but only if the element of variability is an index or rate. Variable payments dependent on a level of output or usage would not be included. For the payments dependent on an index or rate, these are measured using the index or rate as of the commencement date. Residual value guarantees would also be included in the measurement of the lease liability if the lessee expects to make the payment. Options relating to the lease term should also be considered. The exercise price of purchase options should be included where it is reasonably certain that the lessee will exercise the option. And termination penalties would also be included if the expected term of the lease reflects a termination by the lessee. We can now see the effect of subsequent measurement of the lease liability and right-of-use assets. The lease liability will be reduced by payments made, but will increase as the interest expense is recognised. The right-of-use asset, however, will only reduce as it is depreciated. The effect is that the right-of-use asset would typically be expected to be lower than the related lease liability as the lease term progresses. So far, we have focused on lessee accounting. As mentioned earlier, there have been no significant changes to lessor accounting in the new standard. Classification by a lessor between finance and operating leases continues to be based on risks and rewards. Lessors of finance leases will continue to recognise a lease receivable, and for operating leases, they will continue to recognise the underlying physical assets. There are no significant changes to the accounting from the old standard. There are, however, some additional disclosures which are now required, largely relating to the nature of leasing activities and associated risks. Finally, we will take a look at the transition requirements of the new standard. The new standard applies for accounting periods from 2019 onwards. However, the requirements contain some reliefs for preparers. There is no mandatory reassessment required as to whether contracts contain leases. Instead, preparers are allowed to elect to apply the new definition requirements only to new contracts entered into on or after 1st of January 2019. This would grandfather previous assessments performed for contracts which concluded there was no lease, or indeed which concluded that there was. A lessee also has some choices to make in transition. It can apply the requirements of the standard fully retrospectively in accordance with IAS 8, or it can instead elect to take a simplified approach to measurement of the right-of-use asset and lease liability for former operating leases, based on the present value of remaining lease payments. This simplified approach allows the lessee not to restate comparative information. It will also allow lessees not to apply the new requirements to leases ending within 12 months of the transition date. So that's an overview of the key elements of the new standard. The potential impact on some entities could be significant from a financial reporting perspective. Jay will now take us through what the scale of this impact might be based on the results of our global lease capitalization research study.
Thank you, Derek and Patrina. That overview was very insightful. I'm going to spend with you the second half of this webcast on the results of our global lease capitalization study for IFRS reporters. And I'll also touch upon the implications of this new standard for companies and how and when to prepare for the change. So first, the results of our global lease capitalization study. We've analyzed the effects of IFRS 16 on the financial statements of listed IFRS reporters globally. I will walk you through the approach and methodology we applied so you can put our study in context. We've analyzed financial data of over 3,000 listed IFRS reporters around the globe using various automated data sources. We used entities' 2014 lease commitment disclosures and discounted these lease commitments using public credit ratings of individual companies to the extent available, or otherwise we determined a synthetic rating. We then subsequently added the discounted lease commitments to the balance sheets of individual companies and also added back rental expenses to EBITDA. We then recalculated financial ratios and metrics such as the increase in interest-bearing debt and increase in EBITDA or changes in leverage and solvency. And we aggregated the results of individual companies into 20 industries according to the International SIG Code, the Standard Industrial Classification. We also aggregated the results by country and into 8 global geographies. Now on this slide you see the results of this study for all companies in our sample and the results for some of the important industries for leasing. Overall, the IFRS reporters we analyzed will see a median increase in debt of around 22% and a median increase in EBITDA of 13%. Now, median, for those of you who do not have a statistical background, median means 50% of the companies are above and 50% of the companies are below the median. It ignores, for example, outliers, unlike when you would use the average. What we saw in the study is that the average impacts are much higher because of these outliers, hence why we used the median rather than the average. I will just note the highlights from the study during this webcast. Now, many companies lease assets, and the effects of the new standard will be felt across virtually all industries, albeit not every industry will be impacted equally. On this slide, you see some of the heavily impacted industries. Especially retail companies will see the largest impact as they are heavy users of property rentals, but also airlines and other companies with large volumes of leases, such as transportation and infrastructure, or entertainment and telecoms will be significantly affected. Now, bringing leases on balance sheet will, of course, increase debt. This applies to all industries, but for example, debt in the retail industry will double. This impact is, on the one hand, dependent on how much leases a company has today, so the size of its lease portfolio, and therefore how much debt comes on the balance sheet, but it's also dependent on how much debt is already on the balance sheet. For example, an industry such as professional services has small balance sheets today, so the relative effect of bringing leases on balance sheet is quite significant here. So that is why this industry is in the top 3 of our mostly affected industries. Now, EBITDA for all companies will increase. Looking at EBITDA, the median increase, for example, for retail will be 41% with no change at all in underlying activity. And I would dare to say that this is probably the easiest increase in EBITDA that a company has ever achieved in history, thanks to this new standard. And looking at leverage, which we defined as interest-bearing debt divided by EBITDA, shows mixed results, with most affected industries being retail and professional services, and less effect in other industries. Now, the impact on leverage is often not very significant, and it can also be positive in some instances, as the increase in debt is offset by an increase in EBITDA for all companies. On the other hand, solvency ratios decrease across the board for all companies, obviously because you will get more debt on the balance sheet, while equity remains the same. The largest impacts for solvency are in the industries with predominantly leases of large assets, such as real estate, aircraft, trains, vessels, and other similarly large assets. Now let's have a look at IFRS 16 and how it affects the financial statements and financial metrics of an individual company. Obviously, balance sheets of companies with leases will grow. Not just more liabilities on the balance sheet, but also more assets will come on the balance sheet, which might also increase future impairment risks. In the income statement, as Derek already explained before, current rental or leasing expenses will go down and replaced with depreciation and interest expense for all leases. This will in turn positively impact a company's EBIT and EBITDA, as I already mentioned before. Now, looking at EPS, that's a difficult one. It can go down or up depending on various factors, such as the mix of your lease portfolio upon transition. As Derek explained there as well before, this will depend on whether you have more leases in the early stage of their lease term or latter half of the lease term upon transition. But secondly, this will also depend on your decision around the transition approach. The simplified transition approach is definitely the easiest way to transition to the new standard. However, its disadvantage is that you'll see more front-loading of lease expenses after transition, which negatively impacts your EPS. And given the optionalities in the ways to transition to the new standard, whether it's between the retrospective or the simplified approach, or the optionalities within the simplified approach in terms of measuring the asset on lease-by-lease basis, it is important before you make a decision about your transition approach to have clear visibility on what the different options will mean to your financial picture and performance in the years after adoption of IFRS 16. And I would advise to look into that sooner rather than later. Now, currently, lessees present cash flows on off-balance sheet leases as operating activities, whereas under the new model, principal repayments on all lease liabilities will be included within financing activities. IFRS 16 reduces operating cash outflows with a corresponding increase in financing cash outflows compared to the amounts reported today. This will result in an increase in operating cash flows presented and a decrease in financing cash flows presented for all companies. Now, there are many other KPIs that will be impacted by the new standard, such as asset performance and profitability ratios. For example, asset turnover and return on capital employed. But the more interesting question for companies, though, is what is the impact of these changing financial metrics, and how does this affect perceptions of your company, the leverage and performance of a company with its stakeholders? Various arrangements might be affected, such as financing arrangements, remuneration, or hedging arrangements. Think about the impact on management remuneration linked to EPS or EBITDA targets. Or think of a European airline as an example that has US dollar-denominated aircraft leases, which increases FX volatility in the income statement and thus requires changes to its hedging strategy and hedging arrangements. Also, various tax implications might arise. For example, thin capitalization rules that look at a company's debt versus equity ratio today and limit the amount that a company can claim as a tax deduction on interest expense. This will impact real cash. Even if there's no effect on tax at all, then a company will need to manage complex deferred tax accounting arising from leases when various tax jurisdictions retain local tax rules for leases, and thereby creating base differences for the leased assets and liabilities. Now, these changes will result in the need for companies to carefully manage their stakeholders, such as banks and investors, but also internal stakeholders, such as management and oversight bodies. Lastly, the change might also affect future deals and transactions, such as a company looking to refinance its debt or raise funding for growth in the future, or a company that wants to do an IPO in 2019. Changes in perceptions, particularly if you end up above the benchmark in your industry, might result in difficulty to raise this funding or raise capital with investors in the future. Also, another example, sale and leaseback transactions might be impacted. I still see many sale and leaseback transactions in the market today, which is fine. There's good reasons to do a sale and leaseback transaction as long as people and stakeholders involved realize that the off-balance sheet advantage is limited to the next 2 to 3 years and will be gone after that. Now, the standard is finally here. Let's see how and when you can best prepare for the change. There's a few things that you need to know to help you understand the implications and required preparation. First of all, you need to think about this change broader than just accounting. Accounting and reporting is only the tip of the iceberg. This standard will have an impact on your KPIs, your underlying controls, business processes, and systems. Firstly, these effects will arise across your subsidiaries within a group and might impact each subsidiary differently depending on how standardized your local reporting and lease processes are today. Secondly, these impacts will arise and span across a number of departments and functions within your organization, and not just the accounting and finance departments. Now, as said, accounting is just the tip of the iceberg, but it is also the starting point for your implementation journey. You'll need to first understand the requirements of the new lease standard and determine what arrangements in your company are in scope. You need to gather the required lease data and model the financial impact on a pro forma basis to understand the breadth and depth of the implications for your existing arrangements with various stakeholders. You need to determine the new judgments and estimates that were previously not required. For example, what is a lease and what is a service, and what is the lease term that will drive the amounts that are capitalized on the balance sheet. These are judgments which may not have been made with a lot of rigor in the past simply because they did not have a significant effect on the resulting accounting. And last but not least, next to bringing leases on balance sheet, you need to also think about how to implement the significant additional disclosure requirements across your group and how best to transition to the new standard on 1 January 2019. Now, if we move on to the systems, business process requirements, and controls, companies need to think about what their long-term solution will be for leases. One thing is clear, accounting for often hundreds, thousands, or millions of leases across the group in spreadsheets will not be feasible. And companies need to think about a sustainable IT solution for their leases. Now, whether you decide to embed the new requirements in your existing systems environment, such as leveraging your existing real estate system, or for example, you want to account for your leases using your existing fixed asset register for the leased asset and your existing treasury systems for your lease liabilities, or you decide to implement an entirely new lease software system, in both cases, significant systems, process, and controls might need to be implemented or redesigned. Now, the increased transparency of leases across the group might also result in added benefits beyond just compliance. As a result, you might renegotiate existing or new contracts and optimize your lease portfolio base. Or you can achieve cost savings through centralized and enhanced procurement. Some companies might even reconsider their lease versus buy decisions or move to more service-type arrangements, a trend that already exists in the leasing market today, where physical assets are becoming less relevant and integrated solutions and services are becoming more important. The standard, as a result, might accelerate these trends in the market, which will have an impact on lessors' business model and products as lessees' needs and behaviors change. Last but not least, raising awareness of the broader change, getting buy-in and involvement across the departments and functions of your organization, such as real estate, IT, legal, tax, HR, or treasury, is key to the success of an overall implementation of the new lease standard. So, in summary, I would say that IFRS 16 doesn't really introduce major new concepts for accounting. Basically, you will need to account for all leases similar to finance leases today. However, you are bringing something on balance sheet that has not yet been on the radar screen, as it has always been off balance sheet. And many of the companies that I talk to still have lease contracts stored in hard copy binders across subsidiaries, and many of them still manage their leases today using spreadsheets. This means organizations do not have a central view of all their leases, and simply gathering and validating the required lease data will be a challenge and may require significant time, effort, and cost. And once you've gathered and validated the required lease data for the accounting and disclosures, understanding the wider impacts on your arrangements and your stakeholders and implementing any necessary systems, business process, and control changes around leases will provide some other challenges. So the standard, as said before, doesn't come into effect until 1 January 2019. So you can take a measured approach to implementation. But because the changes are not simply an accounting change, it will require involvement of your corporate and local subsidiaries, as well as involvement from various departments and functions across the business, such as finance, IT, HR, real estate, treasury, tax, and legal. You need to start preparing for the change now. You need to start thinking now about how to raise awareness, and how to organize your project management and governance, what resources you will need along the way, and how you will best affect this change throughout your organization. We believe companies should take a phased approach, and the first steps are really around getting organized around your leases. This requires understanding the change, getting a project team together, setting up project governance structure and plan in place, obtaining budget, and engaging with internal stakeholders. Then identifying the in-scope contracts, understanding the as-is situation, and gathering and extracting the necessary data elements and identifying the data gaps. The next steps then are around validating the lease data quality and making sure this data is accurate and complete in understanding the broader impact on your company, its arrangements, and stakeholders. This includes validation and standardization of lease data, modeling the impact on your financial metrics, and identifying the potential economic effects on your arrangements so you can proactively manage these impacts and your stakeholders' perceptions. The last steps are around establishing the new policies, defining your new business requirements, and if needed, selecting a software vendor and implementing process changes in the lease system, including customization, migration, and testing all the way through training and supporting users and getting to business as usual. Now, last but not least, to ensure cost efficiency, minimize disruption to the business, You need to ensure robust project management during the years of implementation, and it's important to leverage technology and automated tools as part of your implementation. Now, we as PwC have a global network of leasing specialists, and we have partnered with a number of software vendors and developed automated tools for leases that can help make your implementation more focused and cost efficient. And we have the knowledge of the lease software systems in the market, and if needed, we can assist you in selecting the right vendor and lease software solution to fit your specific environment and situation. Now that brings me to the end of my presentation. With that, I'll hand it over back to you, Derek, for the Q&A.
Thanks, Jay. So as Jay had mentioned, that concludes the presentation element of the webcast. We do hope it's provided you with a good overview of the requirements of the new standards and some insight into what the potential impacts might be for both the financial statements themselves and the systems supporting their preparation. We would now like to spend a few moments looking at some of the questions we've received over the course of the webcast. Patrina, one of the areas that has attracted a few questions is around some of the recognition exemptions in relation to low-value assets and short-term leases. So low-value assets, particularly the $5,000 when new, and how that should be applied when perhaps you're obtaining a used asset, and for the short-term leases where there might be options to extend. Could you perhaps say a few words about each of those particular areas?
Yes, sure, Derek. I mean, the first thing to say, by the way, is that the board decided to include these exemptions really to provide cost relief for lessees. So the first thing to say is that they're available only to lessees, not lessors. Also, because they are there to provide cost relief, they're also optional exemptions. So if a lessee decides that they think taking these exemptions is not beneficial, then they don't have to do so, and they can simply apply the me and lessee accounting model to all of their leases. However, if a lessee does think that applying either of the exemptions is beneficial and it takes the option, then it would account for these leases as it does today, its operating leases. Now, first of all, maybe if I touch on the short-term lease exemption, I think as you mentioned, Derek, this is what the definition of short-term in a sense, as any lease that has a lease term of 12 months or less. I emphasize lease term because, of course, that means that when you're looking at the lease term, you're making the assessment as you would for any lease. So that would include the non-cancelable period of a lease, but it would also include any optional periods to the extent that the lessee is reasonably certain to extend beyond the non-cancelable period. So that's the first thing, and I know there have been a few questions around if you've got leases that have options to extend, or possibly actually have break clauses. And one of the questions I know asked is again is about, well, what if let's say, for example, I initially have a lease that has a non-cancelable period of 10 months, has options to extend or has a break clause after 10 months. What happens when if I then extend that beyond 10 months? Then what happens is that you may have initially concluded it's a short-term lease, but at the point that then the lessee exercises the extension option, they would be expected to re-look at that lease to assess whether it still actually would be a short-term lease. So to the extent that the lease term changes for whatever reason, lessees would be expected to re-look at that lease and therefore reassess whether it's still appropriate to consider that to be a short-term lease. If I move on to the low-value asset lease exemption, and I suppose this one, in a sense, does what it says on the tin, in that it's trying to capture where lessees are leasing very low-value assets. So the focus here is, when you're making this assessment, is on the underlying assets being leased. It's not looking at the value of the lease itself. It's looking at the value of the underlying asset being leased. And it's also looking at the value of that type of underlying asset when that considering if that underlying asset were new. So even if you're leasing an asset that's not new, you're still assessing and looking at the value of that type of underlying asset when it is new. Also, I would say there's some words in here that says you're looking at that underlying asset, considering it on an individual basis. So if I happen to be leasing 1,000 laptops, I'm looking at the individual value of an individual laptop. In saying that, there are also some words in the standard to say that whilst you're looking at individual assets, you shouldn't be piecing up individual assets into lots of different pieces. So, for example, if I'm leasing a car, it would be inappropriate for me to say that I'm leasing the wheels separately from leasing the steering wheel, separately from leasing the shell, separately from leasing the engine. You should really be looking at complete individual assets that can work in isolation of any other assets. And I suppose finally, in your presentation, I just mentioned that you did mention that there is, some wording actually not in the standard itself. It's included in the basis for conclusions that mentions sort of a value of, roughly speaking, $5,000 US or less. When that's mentioned in the basis, it's really reflecting and saying that this is really that when the board discussed this in 2015, what they had in mind were assets that had a value at that time of, roughly speaking, $5,000 or less.
Thanks, Patrina.
If I can add a few words to that, Patrina, I think it's good that you've mentioned that it's an option, because the exemptions are really options for companies to apply. I've had a number of clients that told me that they're considering not applying some of these exemptions, because if you think about the impacts on systems, processes, and controls, an exemption or an exception to a general rule creates more complexity in terms of design and how to get that organized, and also it might confuse people within the organization. So some clients have already told me that they're considering not to apply some of these exemptions, and that's perfectly possible under the standard.
Thanks, Jay. We did also receive a number of questions about transition, with there being two different approaches which could be taken, so the full retrospective or the modified retrospective. Probably too early to be able to assess whether there will be a preferred approach, but for those companies who decide not to restate their comparatives, depending on the approach they take, how do you think investors will deal with that in terms of income statements not being directly comparable?
Yeah. I think generally, if you look at some of the other standards out there as well, investors do prefer the retrospective approach, in which the comparatives are restated, because that kind of shows a comparable trend. So I think generally that's the investor's preference. Now, I think if a company, for valid reasons, decides not to go for a retrospective approach, I think a company then needs to put in a little bit more effort to explain how this transition approach actually affects the numbers, and particularly to make sure that investors clearly understand what the trends are in the underlying business, because at the end of the day, we're talking about accounting and not the underlying business that changes.
Yeah. I'll just add to what you said, Ajay, as well, to say that as well it's important for anybody that does elect a modified retrospective approach. Within the transition requirements of IFRS 16, there is actually some disclosure that is required. And it is the idea with that disclosure is obviously it is trying to provide some information to investors, because obviously if that approach is adopted, comparatives are not restated, but the disclosure is there to try and give something to investors. What it does, though, is it won't give them a very significant amount of information around the income statement, but what it will do is it asks you to reconcile between what were in your notes as operating lease commitments to what now gets recognized on the balance sheet.
Okay. And then just on the subject of disclosure, Patrina, obviously there are some new disclosure requirements included within the standard for both lessees and lessors. Some of these new requirements are around the topic of nature of activities, risks associated with those, potential future exposure that might not necessarily be fully reflected within the measurement of the liabilities at the balance sheet date. How much extra disclosure are you actually expecting this to result in for companies, and what entities and industries do you think might be quite heavily affected by it?
Good. A good question, and I suppose to answer it, I'll go slightly indirectly and then hopefully directly answer it. So the first is to say for lessees, we really, when you look at the disclosure requirements, we really think of them as falling into two buckets, in a sense, I might say. One is sort of prescriptive list of quantitative requirements that we'd expect all lessees who have material, amounts of leases, and where it is material to disclose this, for them to disclose that quantitative information. And the quantitative information centres around explaining what are the expenses that have flowed through the income statement for leases, what's the total cash outflow, give me some information about the amount of leased assets on the balance sheet by class of assets, give me some maturity analysis, like there is today of undiscounted amounts. And so as I say, that's quantitative. We'd expect all lessees with material amounts of leases to provide that information. In terms of then, we talk about then where lessees may or may not provide additional information beyond that. And a lessee would itself assess whether it thinks it's relevant to provide additional information beyond that base. And then IFRS 16 does include quite a few prescriptive objectives, I would say, that need to be met in thinking about whether to provide additional information. And where we'd expect this additional information to be applied is more where a lessee has a lease portfolio that includes quite a lot of complex features that are not reflected in balance sheet amounts. So, for example, if a lessee has significant amounts of extension or termination options in their leases, where they may have a lot of variable lease payments, where they have very significant sale and leaseback transactions, or potentially where they're providing a lot of residual value guarantees. And so I suppose what I'd say is that you asked the question about how will that compare to today. Well, I think that for lessees that have leases where leases are perhaps material, but are not a very significant element of their business, then probably providing a lot of the base quantitative information will be sufficient. However, I think that for those companies and industry sectors where leasing is a very significant and important part of their business, and I'll mention, for example, some of the retailers, some of the hotels, and some of the others where they perhaps have quite a few leases with, for example, extension options or with variable lease payments, then I think we would expect quite a bit of disclosure there to explain that. And the disclosure that we'd expect to see there is really quite company-specific information, where that lessee would be trying to reflect, its individual lease portfolio and how it actually goes about managing that portfolio.
Thanks, Patrina. Jay, you presented to us the results of the PwC Global Capitalization Research Study. Obviously, the IASB have published their own effects analysis for the new standard. Were there any significant differences between the two?
Well, I think overall the results are quite comparable. I think our research is slightly more extensive. So if you look at the sample size, for example, I think the IASB looked at companies with lease commitment disclosure of over 300 million. We looked at companies with lease commitment disclosures above zero, basically, that have certain lease commitment disclosures. So our sample was around 3,200 companies, and the IASB's was around 1,200, if I remember correctly. And I think the impacts on the industries are also fairly consistent. I think a key difference is we looked at solely at IFRS reporters, and the IASB's research looked into US GAAP and IFRS reporters. And I think also the discount rate that we used was company specific, and I think the IASB used a discount rate that's more generic and not specific to a company. So there are some differences in the approach that we've taken in the sample size, but I think overall the results of the study, including the impacts by industry, are fairly comparable.
Thanks, Jay. A couple of questions also received about some of the more detailed technical aspects of the calculation or the measurement of the lease liability. The index linking variable payments, some questions, Patrina, just around how those actually work in practice, and the idea that you would only start to recognise any changes resulting from those once the cash flows themselves start to occur.
Yeah, so maybe let me explain the inflation-linked payments a bit better. Because again, here, by the way, to try and provide some cost relief, the IASB has decided to have a sort of simplified measurement approach, I would say, to inflation-linked payments. So the first thing to say, of course, was, Derek, when you presented clearly, if you've got payments that potentially will vary based on a change in an index or a particular rate, then those payments do need to be included in the balance sheet amounts. However, in fact, how they get included is that you really, a lessee is not expected to project out what future inflation might be. They really can sort of assume zero inflation. And there is actually an illustrative example in IFRS 16 that looks at this. And what it basically says is, let's assume I have a 10-year lease. Initially, I start to pay 50,000 euros for this at the start, even though that might increase in the future based on an increase in an index. When I initially measure that, I will simply assume that I'm going to pay 50,000 for each of those 10 years, and I'll discount that. What then happens is let's say that in this case, the payments will increase not every year, but it'll increase only at the end of, say, year 3, based on the increase in a particular index. What the lessee would then do is, let's move forward 3 years, and only at the end of year 3, when those cash payments actually increase, will the lessee then update and remeasure lease assets and liabilities for that increase. So just to re-emphasize, inflation-linked payments included, but a lessee is not expected to project out any future inflation.
Okay, that's helpful, Patrina. And then, since you were mentioning discount rates, obviously there are some provisions within the standard in terms of what rate should be used and the alternative rates if it's not available. Any more on that particular aspect that you could share?
Yeah, sure. In terms of discount rates, by the way, the requirements do look very similar and are very similar to what's in IAS 17 today for finance leases. And what's clear, so what we're saying is the discount rate you come up is really it's a contract-specific rate. It should take into account the terms and conditions of the particular lease contract. To the extent that a lessee has the information, then they would use the actual rate that the lessor has used to price the contract. However, of course, that whilst that may be available for some leases, of course, we don't expect lessees to have that information available for so many leases. And so if the lessee doesn't know the actual rate in the contract, then it would use what we call its incremental borrowing rate. Now, that incremental borrowing rate, again, it's defined to take into account the terms and conditions of the individual contract. So what you're really looking at is a lessee coming up with what rate it thinks it would have to pay to borrow a similar amount over a similar term in a similar economic environment, etc.
Okay, that's great, Patrina. Thanks for that. It's helpful guidance. So unfortunately, that's the last question we have time for. So I'd just like to close by thanking Patrina and Jay for participating in this webcast and thanking you for participating and submitting questions. The new leasing standards does represent a shift from the previous guidance, and one which has a number of practical implementation challenges associated with it. Although the effective date is 2019, and that might seem some distance in the future, the complexities of the standard and amount of work which might be involved in preparing for its implementation mean that we do encourage you to start your preparation efforts as soon as possible. Please do reach out to your local PwC contact for guidance and assistance on how best to meet the challenges the new standard will pose. Thanks for listening.